Hi, I'm Krista McNamara, Content Channel Director with ABRN Magazine. So there's many options in today's market that collision repair shops can take, and certainly one of the most talked about, especially today, is growth. So I'm here with Brad Mewes, who's a shop management consultant and author of the blog Supplement Financial Insight for the Automotive Industry Professional. Brad uses his weekly blog to focus on business, finance, and also corporate strategy, but all geared toward the collision repair shop. So Brad, in your recent blog, Grow Like a Consolidator, you focus on how shops can grow inorganically. Can you explain what this means?
Sure. So in business, there's two types of growth. There's organic growth and there's inorganic growth. And organic growth refers to growing, perhaps acquiring more customers, perhaps signing a new accounts, growing your business from an organic standpoint from your existing base of operations. Inorganic growth, on the other hand, is when the business expands. Perhaps they acquire a competitor, or perhaps they move into a new market line. We hear about large multinational companies moving into new countries, and LKQ, for example, is now active in Australia, and they bought companies in Australia. So those are examples of inorganic growth. In the collision industry, the big stories we hear about are the big consolidators buying smaller operations. This is an example of inorganic growth. And the reason that's important is because it's really been the big story of at least the last 12 months and definitely the last 24 months is that growth industry is driven by inorganic growth. If you take, for example, the Boyd Group, they're a publicly traded group out of Canada. They own Gerber Collision, and they publicly disclose all information. They grew inorganically. They spent $124 million on inorganic growth last year, but they acquired $250 million of revenue. So those are really big numbers, and these type of activities are driving substantial change in the industry.
Now, for the smaller shops who are looking to do some inorganic growth, what are some of the risks that they need to keep in mind?
So growing's risky because it involves developing new core competencies that as collision repair operators we don't always have. So growth now in the industry, it's not just about perhaps marketing better to agents or marketing better to the insurance companies. Growth is now about identifying and acquiring potential competitors in businesses in other geographic areas. And being able to do that well and successfully requires that a business owner have a team in place that understands how to source acquisitions, how to evaluate acquisitions, as a team in place that understands how to manage the financial side of the business. And it's more than just understanding the P&L, but also understanding how cash flows through a business, how a deal could be structured financially and legally. And so there's a lot of complexity involved in growing organically, but when done right, it could be a very, very profitable strategy.
Well, there's definitely a lot to consider, and you touched on it being potentially very profitable. What are some of the other opportunities there?
So for let's say for a smaller regional MSO who maybe they have 3 or 4 or 5 locations, there's a lot of opportunity in the industry to grow and acquire other companies. There's a lot of talk how insurance companies are starting to prefer a national model or regional model. And that's important because you're providing a level of service to your customers that a smaller competitor may not be able to provide. There's also this idea of scale. And what scale is as a business grows, a business is able to spread their cost structure over a larger base, thus creating a lower cost per unit. So if you think about scale in the collision industry, if you think about your administrative staff, you have perhaps a general manager, an estimator, maybe you have an auditor and a bookkeeper on file. Well, as that business grows, those you don't have to replicate those positions with much frequency, and you're able to lower your overall cost structure on the whole. And so scale is a very important aspect that's driving consolidation. And companies that are able to build scale, create a truly sustainable cost advantage that smaller operators aren't always able to provide.
What 3 things should shops really focus on in order to grow successfully?
So There's if in this industry, if you want to grow, you have to be willing to grow inorganically, and that's often something that's missed. And so in order to grow inorganically, really you have to have a team, an experienced team. You have to have a deep and intimate knowledge of your financials, and you have to be willing to bring in outside experts. And so I'll kind of break those down a little bit. The team's really important because the reality is, as a business grows, the team is the one that executes on a daily basis, and the owner can't be in multiple places at once. So as you grow from 2 to 3 to 5 locations, having a team that's gone through acquisitions, that's been able to manage the process of integrating a new company into your existing company, that becomes really important because it can't just be done by one person anymore. With financials, understanding your financials is critically important, and it's really about understanding how your balance sheet interplays with your cash flow statement and how that interplays with your income sheet or your profit and loss statement. And so companies that are growing well understand their finances at a very intimate level. For example, when a large consolidator acquires a smaller company, it's very likely they'll put together a 100-day plan and where they'll know the sources and uses of every single dollar of every single cash dollar in that business on a daily or weekly basis. And so it's that level of knowledge about the finances of the business that becomes critically important. Finance is also important too, knowing how to structure a deal, how to structure terms, how to acquire capital to buy other businesses, how to use debt properly. So there's a lot of financial structuring that becomes important when you're growing inorganically. And then lastly, experts. So the reality is that, as I said earlier, you need a good team around you, but we also need experts. And so most collision repair businesses don't have a CPA on staff. And so having a experienced CPA who focuses on deals, who focuses on transactions is really important. Having a lawyer who's experienced with transactions is very important as well, because these are the people who mitigate risk, who are able to identify risk and mitigate risk to help ensure the transaction goes smoothly. Investment bankers and M&A professionals, those are very, very important people as well, because those are people who've seen deals, they've negotiated deals, they've gone through it before, and in the same way, they help ensure that the business owner, whether you're buying or selling, is not getting involved in a situation where they're taking on too much risk and putting themselves in jeopardy. And then if you're of sufficient size, something to think about too when bringing outside experts is the role of private equity. And so private equity, these are actually groups that are investors. They go and they actually purchase stakes in other businesses. And what private equity brings to the table, one, they bring a lot of money, and that's important. But they also bring a lot of financial expertise. And one of the key reasons to bring on a private equity partner is for the level of financial expertise they bring to the firm as well. So those are the high level overviews of growing inorganically and the things you need to do right, and the things that the companies that are growing well are doing right.
Well, thank you so much for your insight. To learn more and to read Brad's full article, Grow Like a Consolidator, you can visit abrn.com/grow now, or you can visit Brad's blog directly at sup-co.com. Thank you.